wonderful day to you. This is Owen McCafferty. Again, I am presenting ideas and thoughts in very short little webcasts so that you can consider some of these ideas. This is a time-dated presentation. I will identify those presentations where the topic area would be applicable to a specific year. The year relates to December 31st, 2024 and December 31st, 2025. And what I'd like to do is go through just a few of the very simple ideas in terms of year-end tax planning. For 2024, let's first focus in on some very simple ideas for tax planning that can really make a difference. First thing is, know your itemized deductions. Often, what many of our clients will do is a seesaw type of approach where they will take a standard deduction one year and then really load up on their itemized deductions in the next year, as well as the itemized deductions for the year to come. So they basically, for the first year of initiation of this seesaw technique, they will take a deduction for the current year's itemized deductions and the subsequent year's itemized deductions to the extent that it's permitted. Now let's go with the most common, easiest to understand element in the seesaw approach, and that is charitable contributions. Many of you listening to this presentation are very generous with your capital that has been accumulated and the treasury that you have amassed in the way that you provide help to those that need it. First of all, you have to contribute to a qualified charity. A qualified charity is identified as a Section 501c3. I know that there's a lot of entities that will say it's charitable in purpose, but you will really not be able to deduct it, even though it's being done for a good cause, unless it's a qualified charity and the IRS has approved it and sent a qualification letter out for a Section 501c3 qualified entity. So the first thing is only give charitable contributions to qualified charities. That's a pretty simple thing to understand. Secondly, give contributions for the charity in a specific year and in the subsequent year, all in the current year. So for example, if I'm starting this technique, I would make my charitable contributions for all of 2024. And the good news is you have the ability to make those contributions. And I would recommend you make them by Christmas instead of waiting until New Year's Eve. Because one segment of proof that the charitable contribution has been made on a timely basis is the charity actually puts it in the bank. It's not essential, but again, if you're looking at what's prudent, I would recommend that by Christmas, you make your charitable contribution. In this example, for the 2024 year and the 2025 year. Now, in order for this to work well, you have to have 2 years' contributions in 1 year. Then, in the 2025 year, you make no charitable contributions, and you wait until January 1st, 2026 to make contributions for 2026 and 2027. Then, in the 2027 year, you make no charitable contributions. So in one base year, you double up on the contributions. This is an excellent way to take advantage of charitable contributions for best benefit. It's far better than trying to utilize the individual retirement account to make contributions after the attained age. It's a far better thing than just making contributions. But using the seesaw approach and taking advantage of the itemized deduction allowance, at least in 2025 and 2024, you're in good shape. Now, the reason why I said before that this is a time-dated video is that on January 1st, 2026, we may have a completely different tax system. One thing for sure is if Congress does not act and the president, whoever that might be, does not sign a bill into law, we will revert to the onerous tax rates that were scheduled under President Obama's administration, when we had one of the highest tax rate increases in the history of the United States. So what I'm saying is for 2024, we have an opportunity. Make a contribution for 2024 and 2025. Then, in the 2025 year, make no charitable contributions. So you'll, in essence, be able to take a deduction for something that you're provided an allowance. Second issue, SALT. I know it's bitter, just a little joke, but the SALT, the state and local income tax limitation resulting from this tax law change, has negatively affected those high taxing states where their population has been hammered with a lot of state taxes, city taxes, both for residents as well as for workplace, any county taxes that may be assessed for income. SALT taxes and state and local income taxes includes more than just the income tax, but also the real estate taxes from a variety of different places was limited to a deduction of $10,000. Now that applies to 2024 and 2025. So in the 2025 year, if we are going to have a change in the tax law where state and local income taxes will not have a limitation, then you certainly want to wait and pay in a year where the SALT tax limitation has been eliminated. I think with all of the notations that are going on and the commentary, that in the event that we have a president and a Congress that is predisposed to elimination of the SALT tax limitation, that in 2025 you may be able to deduct more than just the $10,000 of all the state and local income taxes that you pay. This is a good thing. But I am saying that for 2024, if you are going to itemize your deductions, the itemized deductions will be limited for SALT tax purposes to $10,000. You're not going to do anything about it. Congress might do something in 2025, but for 2024, it's not going to be there. In the 2024 year, you may want to consider starting to accelerate those income taxes by recognizing income in 2024 and 2025, because in 2026, we may be in a much higher tax bracket. So where the common thought is try to defer recognition of income if possible and legally, what I'm going to say is if it's legal and you can accelerate the recognition of income, please do it. Because in 2024 and 2025, we're working on the old system. So here's just a few ideas. I mean, we could go on forever, but those are basic ideas, basic thoughts, something that can immediately save tax dollars, at least at the federal level. It may not apply at the state level because your particular state may not allow a deduction for itemized deductions. So, just a thought, and this is time dated. It applies only to 2024 and 2025. But for 2024, get on the stick. Pull out your checkbook and start writing. Don't wait until last possible moment, because if the charity does not have receipt, you can rely on the alleged date that you filed and wrote the check to the charity. But why even go through the debate? Give early. But then have the fortitude, if you're going to double up on your deduction for 24 and 25, that in 2025 you do not make a charitable contribution. Now, a lot of people who find that you've been a generous donor like to go back to the trough, and they like to then ask you again for 2025. Defer in 2025 and then make your contribution for 2026. The other reason is if we have a tax rate increase, that deduction with the higher tax rate will mean more than in a lower tax rate that could be with us in 2024 and 2025. So this is Owen McCafferty. I'd like to say thank you very much. The whole area of taxes, it follows a very simple thought. The most patriotic thing you can do as an American citizen is to pay the least possible legal income tax. And then if you choose, you can always make a charitable contribution to the federal government or to your state government or even your municipality, and it will be deductible as a charitable contribution, provided it's to a qualified subdivision at the federal or state level. So, good news, if you don't think you're paying enough in taxes, have I got a solution for you. With that in mind, this is Owen McCafferty. Good luck. We'll be with our clients over the next few months talking about tax planning. Hopefully you will listen to this and consider calling up your own CPA and planning a strategy. See you in a bit. Bye-bye.